The RBI governor recently concluded the MPC meet and announced that the repo rate will not change along with other major decisions. But do you know how is it going to affect everything? How did the market react to this? Let's know everything about it in today's ET Markets special video. I'm Neha Vashisht Mahajan. Let's start. First, let's quickly go through the top highlights of the RBI MPC meeting. RBI maintained the status quo and decided to keep the repo rate unchanged at 6.5% for the fourth consecutive time. Standing deposit facility or SDF rates is also unchanged at 6.25%. The limit for gold loans has been increased from 2 lakh rupees to 4 lakh rupees in respect of urban cooperative banks. RBI has also maintained its CPI inflation projection at 5.4% for 2023 to 2024. CPI inflation for Q1 2024-25 projected at 5.2%. Core inflation softened to 4.9% during July-August and has eased by 140 BPS from recent peak in January 2023. FY24 real GDP growth forecast maintained at 6.5%. GDP for Q1 FY25 is at 6.6%. Marginal standing facility or MSF rate and the bank rate is at 6.75%. India's forex is at $586.9 billion as of September 29. Now let's talk about the effect of this on the stock market. The markets reacted quite positively after the RBI MPC decision, as the decision was in line with what the market and the economists were expecting this time. Sensex was up over 220 points while the NSE Nifty 50 was trading 70 points higher at 19,616 during the early trade. Many analysts also said that until the rates in the US go down, the emerging economies are unlikely to see rate cuts, including India. Dr. Mukesh Jindal, co-founder of Alpha Capital, said the central bank kept the repo rate unchanged at 6.50% and stance of withdrawal of accommodation. It is unlikely to have much impact on the markets since this is in line with the expectations of no change from the recent stance. Going forward, market will be watching the monetary policy action of the US Fed. We expect India to start cutting the rates when the US Fed reduces the policy rate, and this is expected to happen between Q2 and Q3 of 2024. Adding about foreign exchange, Abhishek Banerjee, CEO and founder of Lotus Juice, said, Indian monetary policy remains stoic among rising bond yields globally. While MPC delivered on expected lines to keep the rates steady, my worry is that the lure of inclusion of Indian government bonds and treasuries in the JP-GBI index should not cause unnecessary compromise on FX, given that INR is not a freely convertible currency yet. RBI also identified high inflation as a major risk to macroeconomic stability and sustainable growth. However, RBI said that the inflation could ease by September. RBI Governor Shaktikanta Das pointed out that these heightened inflation levels were largely driven by food prices. Vegetables contributed to a third of CPI inflation in the month of July and a fourth in the month of August. Now, after the vegetable price correction, near-term inflation could go down a bit, but the future trajectory will be conditioned by a number of factors such as El Nino, Kharif crops, demand-supply mismatches in spices, and more. On banks, RBI said that the Indian banking system is resilient. Financial indicators of NBFCs are in line with the banking system as per the latest data in June. Lastly, for liquidity management purposes, RBI Governor stated it can also do open market sales to suck out excess liquidity. As the move was unexpected, the yield on the benchmark 10-year Treasury yield surged as much as 9 BPS to 7.30%, marking the biggest single-day rise in 14 months. Well, that is all for today. Stay tuned to ET Markets for more.